1 year ago, I talked about stocks that went on absolutely insane runs. One of them exploded by more than 1,000%, another surged over 800%, a third delivered roughly 180%. So if you had put serious money into the right one at the right time, you could have been looking at life-changing returns. And these weren't random meme stocks, these were quantum computing stocks. The thesis behind them wasn't just hype, and it still isn't. Quantum computing remains one of the biggest technology shifts of the next decade. So in this video, I'm going to show you why this theme still matters, why the opportunity is still very real, and most importantly, what went horribly wrong for so many investors who got involved in these names. Now, fair warning, this is going to be information dense. We're going to walk through the entire quantum computing opportunity, look at 3 specific stocks, talk about what happened to them, and explain why a lot of people still manage to lose badly, even after these stocks made massive moves. Because that's the part nobody talks about. Everyone loves talking about the 10x. Almost nobody talks about what happens after the 10x when people buy too late, hold too long, and turn huge gains into pain. So let's start with the big picture. Why quantum computing? Before we get into the stocks themselves, and before we talk about what went wrong, you need to understand what this technology actually is. Here's the simple version. Regular computers, your laptop, your phone, the servers running most of the modern world process information in bits. Those bits are either 0 or 1, yes or no, one or the other. Quantum computers use qubits, and qubits are different because they can exist in multiple states at the same time. That sounds abstract, I know, but think of it like this. A classical computer reads one page of a book at a time. A quantum computer can effectively evaluate a massive number of pages at once. That changes everything. Problems that would take a traditional supercomputer an absurd amount of time to solve could eventually be tackled far faster by a sufficiently advanced quantum machine. And this is not science fiction anymore. Major breakthroughs have already shown that quantum systems can solve certain classes of problems at speeds that classical machines simply cannot match. That doesn't mean every quantum computer is about to replace your laptop next year. It means the direction of travel is clear, and the governments, corporations, and scientists pouring money into this space know it. That's why this matters. Most retail investors completely miss the scale of what's happening here. Around the world, governments are treating quantum computing as a strategic technology, not a nice-to-have, not a side project, a strategic priority. The United States has committed enormous funding toward quantum research through multiple agencies, defense departments, energy departments, research foundations, all of them are involved. And it's not just America. Countries across Europe, Asia, and beyond are investing heavily because they understand what's at stake. This isn't just about faster computing. This is about cybersecurity, military superiority, pharmaceutical discovery, logistics optimization, material science, artificial intelligence, energy systems, and national infrastructure. Whoever leads in quantum computing won't just own a new technology category, they could reshape multiple industries at once, and that's exactly why the investment case here is so powerful. It reminds me of earlier inflection points in technology. The internet in the 1990s, semiconductors before they became the backbone of everything, artificial intelligence before most people understood what it would mean. At first it sounds too early, then it sounds too technical, then it sounds too speculative, and then one day everyone wakes up and realizes the winners are already up 500%, 1,000% or more. That's how these big technological waves tend to work. And quantum is still in that phase where most people don't really understand it, which is exactly why it's so interesting. Now, there's another reason this matters. The technology is improving faster than many expected. Researchers are finding better ways to reduce quantum error rates, improve coherence, and increase computational reliability. Companies are making progress on hardware. Others are making progress on software. Some are focusing on networking. Some are focusing on optimization problems. Some are trying to build full-stack quantum systems. And one of the most important implications of all of this is security. If quantum systems become powerful enough, they could eventually break many of the encryption systems that secure the modern world. Think about that for a second. Financial systems, hospitals, military infrastructure, cloud networks, communications, all of it depends on encryption. If quantum threatens that, then quantum also becomes part of the solution. That means the eventual demand is not optional. If this technology matures, governments and major enterprises will have no choice but to adapt. So no, this is not just another speculative bubble with nothing underneath it. This is a real frontier with real money behind it, real research behind it, and increasingly real commercial use cases beginning to emerge. The real question is not whether quantum computing will matter. The real question is, How do you invest in it without getting destroyed? Because that is exactly what happened to a lot of investors. Yes, some of these stocks delivered explosive gains, but the same stock that went up over 1,000% also suffered an absolutely brutal draw down from its peak. Another ran hundreds of percent higher and then collapsed. Another ripped upward and then gave back a huge chunk of the move. That's the pattern that traps people. They buy the excitement, they watch the stock go vertical, they feel like geniuses, then they freeze when the reversal comes, they don't trim, they don't exit, they don't manage risk, and suddenly a massive win becomes a disappointing outcome, or even a painful one. That's not because the theme was wrong, it's because timing and discipline matter just as much as the thesis. So let's talk about the actual names, because despite the volatility, the opportunity in these stocks may not be over. In many ways, this story still feels early. But before we get into the individual companies, I want to make one thing clear. Every major innovation follows a similar pattern. First, the story captures attention, then capital rushes in, then expectations get completely out of control. Then reality hits, not because the innovation is fake, but because adoption takes longer than people hope. That leads to brutal crashes. And this is where most people get confused. They see the crash and assume the whole thing is dead. But historically, that's often not what happens. What happens is the hype collapses, the weak hands get shaken out, and the real long-term winners eventually emerge from the rubble. That's why the smart money usually doesn't chase the most euphoric part of the move. It waits for structure, it waits for better entries, it waits for fear to replace greed. That's where we are starting to get interested again. So let's begin with stock number 1, IONQ. IONQ is the revenue leader in this group, and that matters. In a space where many companies are still closer to science projects than commercial businesses, IONQ has actually shown meaningful revenue growth. It became the first publicly traded pure-play quantum company to pass the $100 million annual revenue mark, and that immediately separates it from much of the field. That tells you something important. It tells you this company is not just selling a dream. It is already building a business. Its recent growth rates have been eye-catching, and management is clearly trying to position the company as one of the first serious commercial leaders in the sector. That doesn't make it cheap. It doesn't make it risk-free, but it does make it relevant. Even more importantly, ION has had a very strong cash position, which gives it flexibility. In an industry this early, cash is oxygen. It funds research, it funds acquisitions, it funds survival. It gives a company time to execute. And in emerging technologies, time is everything. IONQ has also made strategic moves to strengthen its vertical integration and deepen its position in the broader quantum ecosystem. That matters because if this industry scales, the companies that control more of the value chain could have significant advantages. Now, does that mean there are no risks? Of course not. Valuation is still aggressive by traditional standards. Profitability is not where conservative investors would want it to be. Execution still matters enormously, and if the broader market turns risk off, names like this can get hit very hard. But within quantum, IONQ remains one of the names you have to take seriously because it combines narrative funding and commercial traction better than most. Now let's move to stock number 2, D-Wave Quantum. D-Wave is interesting because it's doing something a little different. While a lot of quantum companies focus on gate model quantum systems, D-Wave has built its story around quantum annealing. Now that might sound like obscure technical language, but the practical takeaway is simple. D-Wave has focused on optimization problems that businesses actually care about right now. Things like routing, scheduling, logistics, manufacturing workflows, and supply chain optimization. In other words, not just futuristic theory, nearer-term use cases that matters a lot. One of the biggest problems in emerging tech investing is that investors often back companies with incredible technology but no practical commercial bridge to today's market. Leewave at least has a clearer argument for why some customers might pay now, not just in some distant quantum future. Its revenue base is still relatively small, so let's not pretend this is some mature dominant company. It isn't. It's still speculative. It's still risky. It's still proving itself, but one of the things that makes D-Wave stand out is that the company has shown signs of being able to monetize highly specialized technology at strong margins. That is not easy to do when you are also dealing with difficult hardware challenges. It suggests that what they are offering has enough value for customers to tolerate premium pricing, and that's exactly what you want to see in an early-stage frontier technology company. They've also built a customer base that gives at least some evidence of commercial relevance. Again, that doesn't remove the risk. It just means this is not a zero-substance story. The challenge, of course, is consistency. Can they turn technical interest into durable revenue growth? Can they keep expanding real-world adoption? Can they survive the inevitable volatility that comes with this space? Those are the right questions to ask. So D-Wave is not a safe stock. None of these are. But it is one of the more interesting pure plays if your goal is to get exposure to quantum through a company that is already trying to solve business problems people understand. And now we get to stock number 3, Rigetti Computing. This one is probably the most controversial of the group and maybe the most interesting from a risk-reward perspective. If you only look at the revenue numbers, you may not like what you see. The top-line performance has been underwhelming relative to what investors want from a company in a hot sector. That's the first thing you need to understand. Rigetti is not really a revenue story right now. It's a technology and execution story. If the roadmap comes together, the upside could be substantial. If it doesn't, the downside is obvious. So this is not a stock for people who want comfort. This is a stock for people who understand they are making a high-risk bet on technical progress. Now, why do people stay interested in Rigetti despite that? Because the company has demonstrated progress in areas that matter deeply in quantum hardware fidelity, speed, fabrication control, and system development. In plain English, they are trying to build high-performance quantum hardware with more in-house control than many competitors. That matters. When a company owns more of its fabrication and development stack, it can potentially move faster, iterate more efficiently, and protect more of its know-how. That doesn't guarantee success, but it can create strategic advantages. Rigetti has also benefited from partnerships and broader ecosystem positioning that keep it on the radar. When major players in advanced computing acknowledge your relevance or integrate with your broader ecosystem, investors pay attention, and they should, because in frontier industries, third-party validation matters. You want signs that the company is not developing in isolation. At the same time, let's be honest, this is a volatile name. It has experienced huge swings, it attracts momentum traders, it attracts speculation, it attracts people who often don't fully understand what they own. That combination can create explosive upside during hot phases and vicious downside when the momentum breaks, which brings us right back to the central lesson. Even if you identify the right seam, even if you identify the right stock, even if the stock goes exactly where you thought it would, you can still mess it up if you don't know how to manage the position. That is the lesson so many people keep learning the hard way. The stock goes vertical. They stop thinking clearly and they start imagining infinite upside. Then the reversal begins. At first it feels normal, then it gets worse, then they tell themselves it will bounce, then suddenly the stock is down 30%, 40%, 50%, 70% from the top, and they're sitting there wondering how a huge winner turned into a psychological disaster. That is not a quantum computing problem. That is an investor behavior problem. And it happens everywhere in AI, in biotech, in crypto, in clean energy, in small caps, in hype cycles of every kind. So yes, the quantum opportunity is still exciting. Yes, these 3 names are still worth watching. Yes, this story could still be early. But if you take nothing else away from this video, take this. A great investment theme is not enough by itself. You need timing, you need structure, you need discipline, and you need to know before you enter under what conditions you are going to reduce risk, take profit, or get out. Because otherwise, the market will eventually teach you that lesson in the most expensive way possible. Now, stepping back, what do I think the real takeaway is here? If you miss the first move in quantum, that doesn't automatically mean the opportunity is gone. In fact, major technological revolutions often create multiple waves. The first wave is usually awareness. The second is speculation. The third is disillusionment. And after that, the real businesses begin to separate from the noise. That's why this next phase may matter even more than the last one. The easy money in a straight line panic rally. That's usually where emotion dominates. The more thoughtful money, the money made by people who understand the theme. Study the companies and wait for better setups often comes later. And that may be where we are heading now. So keep your eyes on the space. Watch the leaders, watch the revenue, watch the partnerships, watch the balance sheets, watch the price action, and most importantly, watch your own behavior, because the next decade could make quantum computing one of the biggest technology stories in the entire market. And if that happens, the opportunity will be enormous, but only for people who know how to participate without getting their face ripped off in the process. This is Dalio Decoded. If you got value from this, make sure you subscribe and let me know in the comments if you want more deep dives on emerging technology trends, asymmetric investment opportunities, and the sectors that could define the next decade. And if you missed the early runs in names like Nvidia, don't assume the biggest opportunities are behind you. The next monster trend may already be taking shape right in front of you.